My guest host tonight, Mark Ingham from ETM Analytics and Wayne McCurry from Momentum Asset Management. Welcome, guys. Wayne, you say you don't wear pink.
No, I don't wear pink now.
So, Mark, what does this mean about your attitude to the market?
I'm a real man, of course.
Because you wear
pink and I can get away with it.
So, Mark,
I hope so.
How do real men, metro men, respond to what's happening in the market? We still have the thin volumes, but
Yes.
it's as though we're all waiting for Jackson Hole. Somehow this is going to be this saving grace for the markets.
But let me tell you, metrosexuals, they rise above all this popcorn stuff and all these influential noises. They just do their own thing, sort of metrosexuals. And I think pretty much what we'll see in the next while is probably the odd nugget of wisdom coming out of Jackson Hole. Is it going to change the world? Probably not terribly much. Is it going to influence the way people who run businesses go about doing the way they run businesses? Probably not.
When Mario Draghi's saying he won't be there and it probably doesn't mean much, but the fact is I think it demonstrates to the markets that he's serious about solving Europe's problems.
But I mean, exactly what Mark was saying, we know what's happening. The Federal Reserve Bank in America has said 50 times, look, if things really get bad, we'll step in and sort it out. But things haven't really got bad. The European Union and the ECB and Draghi has said, we will do what's necessary to sort this out, and the German Merkel has said this, and so there's where's the new news coming? So I agree. It's good to have these talk shops. It's good to disseminate information, but it's not going to change the world as we know it.
Mark, you said nothing will probably happen, but if you look at some of the news from yesterday in the US, you had two Fed presidents, different regions, saying exactly the opposite. The one saying the Fed should ease straight away, no longer wait for more economic news, and the other saying it's not helping, it doesn't stimulate the economy.
Well, that's precisely why it is the United States, the continental United States. You've effectively got 50 individual countries. And what's happening in New York may be completely different to what's happening in the sort of Nevada or California. And so you do get regional economies, and each economy, in fact, even within a particular state, may have different sort of characteristics. So they are absolutely right. It's not a one-size-fits-all situation. It's not a sort of command and control centralized economy.
Well, let's look at how South Africa fits into all of this. Our economic growth rate quickened to 3.2% in the second quarter, more or less in line with expectations. It compares with a 2.7% expansion recorded in the first quarter and puts first half growth here at 2.5%. Most of the impetus came from the mining sector, which surged from the first quarter's bombed out levels. Agriculture too had a strong showing. George Glynos is Managing Director at ETM Analytics. He joins us here in studio. Hi, George. Welcome.
Hi, Erika.
So are you going to brag that you expected this number? Because it really depends who one asks.
I didn't expect this. I was actually very disappointed with this figure. We were looking for something north of 3.5%, and having a look at the breakdown, really disappointed in manufacturing. It was the one sector that we completely overestimated in terms of what it would produce. We thought it would shrink. No question, but to the extent that it did was a little bit of a surprise for me.
Down 1%, quarter on quarter.
Yeah, I mean it was a very strong negative, and I think that's a little bit concerning. It suggests that there's quite a lot of margin pressure coming through there that would be compounding the effects of just a general reduction in sort of activity that the numbers are pointing to. So this goes a little bit further than just activity. It's actually a margin squeeze as well.
So let's stay with manufacturing because it reflects the weak Europe because they buy many of our exports. It reflects currency movements. And I think of imports too. Can't help thinking of Rainbow Chicken results out today. Wayne,
very much so. But Rainbow and Country Bird, I mean, they're suffering from very cheap imports and the price of maize going up. But when you talk about manufacturing South Africa, this industry has shrunk hugely over the years. I would have thought the weaker rand would have helped it a little bit over the last quarter or the last 6 months, because the rand has weakened, a little bit, which obviously you would think will be good. But I mean, a question directly to George: is there any answer for manufacturing in South Africa, or are we just inherently uncompetitive because of geographics, volume? Do we need protection, or are we just uncompetitive?
Inherently uncompetitive. I think there's potential to be a lot more competitive than we are. I like the fact that you mentioned the rand and the fact that it hasn't in fact boosted much in the way of the productive sector of the South African economy, because it actually makes a very good point there, that it's actually not about the weakness of the rand. If demand doesn't exist for your product to begin with, it almost doesn't matter what level the rand's trading at, the demand's simply not there. And to believe that just dropping the price of a good will suddenly stimulate all of this demand, that might work on an economics graph, but in reality it sometimes works quite differently. So I think we are fairly synchronized with what goes on abroad, and the trick for the manufacturing sector more than anything else is to try and extract that lean and mean productivity that you need to extract in times like these to be able to survive this downturn. For when the upturn comes, you're better positioned to handle it.
Does the minister understand this? What about the new growth path, which essentially says weaken the rand but keep inflation under control?
Well, and that's possibly one of the biggest criticisms we have with the new growth path is this interventionist mentality. I believe, if anything, raises the tax burden on the tax base and doesn't necessarily generate the kind of returns that you're looking for.
I think also, per your point, George, with currency, if you can only rely on currency to be in business, then you're not going to be in business for that much longer. And from my experience, it's one of a number of variables, and often the case, not the most important variable either. I can think of one or two companies in the manufacturing arena who have right-sized their businesses to be competitive at around about R6.50 to the dollar.
Yeah.
And in fact, they're saying at 8 to 8.50, this is nice to have, but we're not banking on it.
Mark, name a few. Name those who are successful.
Chemspec, very good paint manufacturing business down in KZN. Hulamin, for instance, they've effectively right-sized their business to around about the R6.50 level. And there's various others too. The automotive manufacturing sector is a very good point, particularly the tier 1 and tier 2 suppliers who supply into Roslyn, Silverton, sort of Prospecton. They have to right-size their businesses for what is a global norm, not a South African norm. So if you're supplying into Toyota or Ford or whatever it might be, your pricing has got to be on par with the best anywhere in the world.
George, going back to those GDP numbers, so we spoke about manufacturing, the huge disappointment. Very interesting. Construction up by over 4% on the quarter. Certainly not what we're seeing from the construction companies. What's happened there?
You know, it's a very good point because, look, there is a bit of a base factor issue there, so we don't want to get too carried away with a number. But we do know that government has been planning on some of the infrastructural rollouts that they're supposed to implement through the course of the next few years. I was at a presentation by Transnet fairly recently, and it's enormous what they've got planned. So I suspect that there is some work in the pipeline. But it's more on the government side of it. On the private sector side of it, things I think are a little bit sluggish, and perhaps that's more reflective of what you're seeing in the numbers.
And I have to ask you about the trade sector. That's really where all the life and the excitement and support for the economy has been, up 2.8% in the second quarter. Compare that with 6.1% in the third quarter of last year.
Yeah.
Certainly a downtick.
For sure, and I think if you know, just to give a little bit more perspective on this slightly sluggish performance, is if you had to strip out just because there were some technical reasons for this huge bounce back in the mining sector. We had the strikes in quarter one, and so a very depressed base. So all we've done is really normalize activity. It's not as if we've expanded the sector at all. But yet it still comes up in growth. Strip that out of the numbers and you've got a growth rate closer to about the 1.7% mark, which is a significant slowdown from what we saw in quarter one. And I think that there speaks to a broad-based slowdown, which I think is going to gather momentum in the third quarter and remain fairly sluggish in the fourth quarter if what we're seeing overseas is anything to go by.
So, George, do we see another interest rate cut?
Well, it's certainly, you know, given the way that the Reserve Bank interpreted the environment at the last MPC meeting, I'm not in favour of further cuts. I think our monetary policy is more than accommodative.
You didn't foresee the July cut?
No, we didn't, absolutely.
I don't think anyone did.
I don't think many people
One or two
did.
did.
No one.
One or two. But they were in the minority and good for them. But the communication that we had from the Reserve Bank didn't hint at that. But given the way that they've interpreted everything that's happened recently, you simply can't rule it out. It's not my preferred view, but you cannot rule it out.
We know manufacturing, there's no real growth there for a while. We know mining, there's no real growth there. There's no real growth anywhere. Where's the money coming from? How can all the retailers show these 15 and 16% turnover increases, 4-5% real turnover increases. Where's the money? There's no new jobs. Where's the money coming from?
That's, again, very good question. What we are finding is if you have a look at the breakdown of the credit extension numbers, it's where the credit extension is taking place. So by far the biggest contributor to credit extension is mortgage advances, but they are flat. So there's nothing coming from there. Where you see the growth, and growth in credit extensions currently are hovering around the 8-8.5% mark, but you look at the unsecured lending, you have a look at some of the credit card expenditure, again unsecured lending in a form, and that's ramping up very, very strongly. So through the course of the past, from 2009 to now, you've had a 220% increase in that unsecured lending space in some instances. And I think that there starts to explain some of it, at least some of it. We've had a benign inflation environment as well, which has helped too. But generally speaking, the consumptive side of this economy is still ticking over.
Mark, from an equity perspective, what do these numbers in the detail tell you or confirm to you about your portfolio or the direction in which you'll be going from here?
You know, I don't place a lot of store by quite a bit of this data, because a lot of it's quite, first of all, it's dodgy as the data we have in South Africa. Secondly, it's backward looking, okay, and oftentimes it doesn't represent what companies are actually truly experiencing on the ground. And it also doesn't reflect what different management styles do either. So, you know, at the end of the day, I effectively ignore it. And I look at individual businesses, and some businesses that you would think should be falling off a cliff because of these economic data are actually doing pretty well. So, you know, again, much we were saying about the US, one size doesn't fit all. And I think always follow people, the right people in management. You know, that makes a difference.
Final word from you, George. You spoke earlier about the interest rate implications. Will the motivation for any adjustment or not come from the external economy? What's happening in Europe, US, elsewhere?
I suspect it will. You know, we've had a theme that we've latched onto for the past few months, and that theme really is the kind of pressure that gets exerted by these international economies that are running these zero interest rate policies, that are printing up a lot of money. That money's got to go somewhere. At this point in time, we know that it's getting exported out of the US and the UK and Europe, and it's finding its way to emerging markets and forcing down bond yields to such a degree, and forcing down money market rates as well, to such a degree that the banks in some instances are financing themselves at a rate cheaper than the repo rate, which almost renders monetary policy less effective than it would. And I think that pressure gives perspective on the kind of influence that we are going to see continue to be exerted on South African rates, potentially towards the downside.